Hey everyone, and welcome. Today, we're going to dive into the wisdom of the legendary investor Benjamin Graham. We're going to use his insights to uncover the truth behind a really tempting type of investment, one that promises you all the safety of a bond, but with the awesome upside of a stock. The big question is it just too good to be true? Well, let's find out. I mean, this is the big one, right? It's the absolute dream for so many investors. The idea that you could capture all of those amazing gains without taking on any of the heart-stopping risks. Well, that exact promise is how a certain type of security is often sold to people. It's called a convertible bond. So let's really take a look at this supposed magic bullet for investors. The sales pitch couldn't be simpler. You get that cozy bond-like safety if things go south, but you also get that exciting stock-like upside if the company just takes off like a rocket. I mean, on paper, it sounds absolutely perfect. Okay, to make this super simple, just picture this. You have a magic box. Now, most of the time, it's just a totally reliable piggy bank, It gives you a few coins on a regular basis. But if the toy company that made it suddenly becomes wildly popular, you have this special option to transform that box into a super valuable toy robot. That right there, in a nutshell, is the incredible appeal of a convertible bond. But how does this magic box actually work out there in the real world of finance? What's going on under the hood? Let's break down the actual mechanics behind these strange hybrid securities. So here's the deal. The most crucial point to get is that it's a blend. A company issues it as a piece of debt, that's the bond part, and they promise to pay you interest and give you your money back down the line. But baked right inside is this special feature. You get the right, but, and this is key, not the obligation, to swap that bond for a certain number of the company's stock shares at a price that's already been set in stone. And you can really see the two different personalities of a convertible right here. On one side, you've got the safe, predictable bond. You get your fixed interest payments, the promise of getting your principal back. It's steady. But on the other side, you've got the exciting stock option, holding all that potential for massive growth if the company's stock price just soars past that conversion price. Now, this is where the genius of Benjamin Graham really comes into play. See, he looked at this whole best of both worlds promise and realized it wasn't free, not by a long shot. There's a hidden price tag. And understanding what that price is, well, that's the key to avoiding a classic and very painful investment trap. Graham's core insight is summed up perfectly right here. That conversion feature, the magic part we talked about, it isn't some free gift from the company. No way. You are actively paying for that privilege. And the kicker is, if the stock never does well enough, you've paid for a privilege that turns out to be completely worthless. Okay, let's put some real numbers to this so you can see exactly how this hidden cost works. Let's just imagine a company's convertible bond is trading on the market for $1,050. Now here's where it gets really interesting. If you were to just strip out that fancy conversion feature and value this thing purely as a regular, plain vanilla bond, its fair price might only be $1,000. So what about that $50 difference? Well, that's the premium. That is the hidden cost you paid for the chance to maybe convert to stock later on. You've basically bought a lottery ticket. And what Graham wants you to do is ask yourself, is this ticket really worth the price I'm paying? But wait. It gets worse. You're not just paying that upfront $50 premium. Oh no, there's a second, much more subtle cost that's quietly draining your returns over time. And that's what we'll call the interest rate trap. So as you can see here, the cost just keeps on building. A regular, non-convertible bond from the very same company might pay you a nice 5% interest, but the convertible version, it only pays 3%. That 2% difference year after year after year is all the income you're giving up, all for that conversion privilege. It's just another part of that hidden price tag. All right, so you've paid a premium and you've accepted a lower interest rate. What happens when reality finally hits? Well, this is where Graham's brilliant concept of the double disappointment comes in. It shows how you can actually lose out in both the good times and the bad. Okay, scenario number one. Let's say the company's stock does poorly. It tanks. Your conversion option? Poof, it's completely worthless. Now, yeah, the bond side protects your principal, which is good, but you're now stuck holding a bond that pays a really subpar interest rate, way less than what you could have gotten from a regular bond. That's disappointment number one. But what about scenario two? The stock price soars. It goes to the moon. Your conversion option is now super valuable. Amazing, right? Well, here's the twist. In the kind of strong economy where stocks tend to rise, interest rates often rise too. And when interest rates go up, the value of existing bonds with lower payouts goes down. So while the stock part of your investment gained value, the bond part actually lost value. You end up missing out on a huge chunk of the stock's actual gains. And that, my friends, is disappointment number 2. So how on earth do you avoid this trap? Well, as he always does, Graham provides a clear, logical framework. He came up with a simple but absolutely brilliant 2-part test that every intelligent investor should use before they even think about buying a convertible. Here it is, it's so simple. First, you completely ignore the conversion feature. Just pretend it doesn't exist. Look at it purely as a bond. Is it high quality? Is it paying a reasonable interest rate for the level of risk you're taking? If the answer is no, you stop right there. Game over. But if it's a yes, you can move to part 2. Now, look at the stock option part. Is the conversion price attractive? Is the potential upside really big enough to make up for the lower yield you're stuck with? The key here is that a security has to pass both of these tests, not just one or the other. Now, this whole principle of separating the safe part from the speculative part is just so important, and Graham applied this rule even more strictly to a related security that he considered to be pure, unadulterated speculation: warrants. So, what's a warrant? Well, you can think of it as a long-term stock option that's issued directly by a company. They often attach them to bonds to make the whole package a bit more attractive. But unlike your typical options that might last for a few months, warrants can last for many, many years, giving the holder the right to buy stock at a set price. Graham could not have been more clear on this point. He saw warrants as a pure gamble. And why? Because they have absolutely no safety net. None. They don't pay you interest like a bond does. They have an expiration date, which means their value is constantly decaying over time. It's an all-or-nothing bet that the stock price is going to go up. And that really brings us to the single most important takeaway from all of this. Whenever you're faced with one of these hybrid securities, you just have to remember Graham's simple, powerful rule. It must be a good bond and a good stock option. It's both or it's neither. If it fails on just one of those counts, the intelligent investor simply walks away. Because ultimately, the goal isn't just to get the best of both worlds, it's to make absolutely sure you avoid the worst of them.